Following what was a better than expected inflation report on Thursday, November 10th, the stock market rallied 5.5% in one day, a shocking move that has happened only 18 times since 2000. This now puts the market just 17% from its all time highs, and considering everything that has happened this year's market is nothing short of a miracle. Now on everyone's mind is the big question. Was this dip right here on October 14th the bottom? And considering we've had an ease in inflation, are we set to see the stock market burst up in the weeks and months to follow? Is this bear market finally over? Well, according to legendary investor Carl Icahn, we are not even close. He recently went on CNBC to explain why he's still very bearish and expects more pain ahead for investors. Take a listen to him explain his shocking investment theory, one that centers around big jumps in price like the one we just saw on Thursday. It's an interesting case that should make you think twice about buying the current dip.
Good to see you, Scott.
So what is your reaction to this incredible rally that we saw today on that better than expected inflation report?
Well, you know, I've been bearish for a year and a half or 2 years, but we keep our portfolio hedged, so it doesn't mean a lot from the net worth of our portfolio or IP too much. But I am still very or quite bearish on what is going to happen. A rally like this is, of course, very dramatic, to say the least, very dramatic. But you have them all the time in a bear market, and I still think we're in a bear market. You have these rallies because it's almost like a commodity. There's only a certain percentage that actually trade it or make that final move in it. So if you take the population of stockholders, there's only a small percentage that trade like this or move it. And when the market goes down, you have a short interest builds up. And then when you have any news, it suddenly propels this. So I do think it's certainly dramatic and maybe exciting, but I don't really think it changes my opinion on the basic problems that we have.
Now, what Carl is saying here is something that happens during every bear market. You get massive volatility in both directions. For example, earlier I said that a 5% move in the S&P 500 has happened only 18 times since 2000. And as Ben Carlson pointed out on Twitter, it turns out that every single time this has happened, it occurred during a nasty bear market. 9 out of the 18 times happened in 2008 and 2009 during the middle and tail end of the great financial crisis. 5 of the 18 happened during the 2020 crash when the world was shutting down, and 4 more happened during 2001 and 2002 in the last half of the tech bubble imploding. All of that proves what Carl was saying. Essentially what happens during these bear markets is that you get less and less participants trading and short interest builds up. This means betting against stocks gets more and more popular. When this happens and we get even a tiny bit of good news like we did on Thursday, a lot of these shorts are forced to cover and we get giant movements to the upside. Think of it as a mini market-wide short squeeze. But as I mentioned earlier with those dates, these are often short-lived rallies and stocks continue to plummet in the weeks to follow. You can get a sense of just how crowded short interest is by looking at the put-call ratio, which essentially measures how many people are betting against the market versus how many are betting with the market. In the week before the CPI report, you can see that this ratio got very one-sided on the put side, meaning that a lot of money was being bet that the market would go down, and when there was a bit of surprising good news, this is what happens. Carl Icahn thinks that this is just a start and the market will continue to plummet downward, despite these rallies that we see over and over again. One quick look at the S&P 500 this year and you can see that we've had plenty of weeks, even months, where it looked like we were going to make a full recovery, but they always die out as we move towards the downside. You can hear Carl explain in detail why he thinks this dramatic fall will continue for a while. Take a listen as the reporter presses him on his reasons.
Why are you so negative on the market?
Well, whenever you have higher interests that have moved as they have here, and they really have moved quite a bit, you know, and you have an inverted yield curve, you're getting really treasuries at a 5% yield, close to a 5% yield for relatively short-term treasuries. You are going to have a recession. And I think you do have a recession already. I mean, if you looked at the earnings of a lot of these companies, they're pretty bad. And I think a lot of these companies are cheap, by the way. And I think a lot of money will be made if you own certain of these I like to say the Graham and Dodd type companies, not so much the high-tech companies. If you own them, they're dirt cheap, and eventually you'll make money. But I think there's a way to go down because I don't think inflation is going away to begin with, not for the near term. And I think you're going to have more of a recession, more of an earning decrease. And that's basically why. I think, to begin with, I do think you're going to have more wage inflation. A lot of people don't want to work. I mean, it just comes to it. You have people now, the youth. I mean, you just saw this election where a lot of Democrats won where you didn't think they were going to win, and I didn't think that a lot of them would win. But what you do have is a lot of, quote, the youth. They say in quotes, the youth vote. And when you think about it, if you don't have to work and you've been geared to that, you're going to have wage inflation because by definition, people get older, they retire, and you have to fill that in. So you have that situation here. So you got wage inflation. You certainly have housing now going down. You have the net worth of the median household in this country. The net worth of the median household is maybe $100,000. And even that is in question. Even the households that do have a net worth of more than that, the housing is going down and the market has gone down for it. So you have all that put together. You have higher debted companies too, because you take a lot of these companies have borrowed money over the years and bought back stock. And they still do it. They still do it. I think that's dangerous because now they're encumbered with the debt they have to pay on the money they borrowed to buy back stock. So I just think there's a lot of things that have to happen to turn this economy around, to get us out of the recession.
So essentially, if we break down Carl's reasons, they come down to 5 points. One is that the yield curve is inverted. This financial indicator has always correctly predicted recessions throughout history. If we look at the 10-3 spread, which is the commonly looked at indicator for this type of analysis, you can see that it inverted in late October and has continued to plummet this month. On top of this, inflation is raging and the Fed will continue to fight it with higher and higher rates. Now, of course, we just saw a small decrease in CPI, but that doesn't change the fact that we may be entering a period of long sustained inflation with ups and downs. In the 1970s and the 1980s, we saw the same type of action with inflation behaving almost like a roller coaster. And with less and less people working, wage inflation has become a bigger and bigger problem going forward as employers are compelled to pay more and more for limited labor. Finally, Carl Icahn mentions earnings and corporate debt. A lot of these companies have enjoyed an entire decade where money was basically free to borrow. A lot of them got used to this, just borrowing their problems away, and now that rates are going up, this type of behavior will no longer be possible. Real profits will be necessary to grow and prosper. We are already seeing earning projections come down, and with more and more companies struggling with this new era of hard money, the market will reflect these issues rather quickly. In summary, Carl Icahn is not optimistic about the future near-term returns, and a lot of problems will need to be solved before he changes his mind. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed the video.